Welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm Courtney Reagan, your host here today, filling in for Bob Pisani. Well, investors are eager to close out the books on a very rocky August and turn to September. But with worries over persistent inflation, lofty valuations, and a weakening China, could there be more than just a September swoon ahead? This big issue, of course, for September is threading that Goldilocks needle. You want data that isn't too strong, but that isn't too weak. And seasonality is not on the market side. So what can we expect in the month ahead? Joining me now is Tom Lydon. He's vice chairman of Verify, and Christian Magoon, CEO of Amplify ETFs. So Tom, we actually saw outflows in August for the first time since February, but demand for fixed income actually appears to be pretty strong. $5 billion in fixed income inflows last month. So what's the big story for September?
It's a great point. Usually the equity flows dominate all flows by a big amount, but we did see almost 50-50 so far this year as far as flows in fixed income. I think the key here is the Fed's doing a decent job in tackling inflation, but there's a lot of money that's on the sidelines, either in short duration or in money market funds, $6.2 trillion. And with that in mind, we're hearing from advisors that we're surveying at Verify all the time, they're starting to unleash that money on short duration, going to longer duration, not just in treasuries, but also in corporates and high yields, with the idea that a year from now, if we do hit a recession and the Fed comes in, starts chopping interest rates, they're not only going to get that higher yield for longer, but participate in some of that appreciation as rates start to come down. If you're just sitting there in money market funds and the Fed comes in and starts chopping, you're not going to have that 5% yield anymore, and it's tough to make that up.
Interesting preparation for what may be coming.
Yeah.
Christian, it seems like fear of the growth trade is fading, though investors still favoring a little bit of a risk-off approach. What are you seeing in inflows?
Yeah, I mean, Tom said it best. People are really mesmerized by a 4 or 5% return from fixed income. In our side at Amplify, we're seeing income strategies be appealing, but these income strategies are yielding 5, 6, 7, 10%. Across our lineup. So we're definitely seeing inflows, looking at income products that can give you some type of market participation, but don't rely on total return, that have an income element to it. So, for example, our ETF of discounted closed-end funds, YYY, yields around 10%. We have another international dividend ETF that yields around 6%. This, again, gives you the market participation, but also gives you that income. And, the bar has been raised now for material income. You kind of got to do something bigger than 5% to get money to move nowadays when it comes to equity income strategies.
So if we're talking risk off, Tom, do you think that the mega cap tech trade has faded? Are we less interested in some of those magnificent 7 names? And it looks like we're seeing a little bit more flows into small caps and equal weighted indexes. I mean, does this suggest a renewed sense of bullishness for the broader market?
Well, there is, for sure, and especially in the last 3 months, where at the beginning of the year, that magnificent 7 and really throughout the year was responsible for almost 80% of the growth that we saw in the S&P 500. However, if you look at the equal weight, which Invesco has an RSP, it's called RSP, which is their Invesco 500 equal weight ETF, that's up almost as much as the S&P 500 is in the last 3 months. Also, the Russell 2000 is up a little bit more over the last 3 months. So with that and the flows that we're seeing around that, we've seen almost $8 billion come into RSP, which says people are looking to spread the love a little bit outside of those mega cap stocks. And also from a valuation standpoint, boy, small cap valuations look real cheap compared to the S&P 500 right now. You can get them for 40, almost 50% off from a valuation standpoint. And then on top of that, overseas markets aren't seeing a lot of love, but valuations in the same way. So as you look towards the end of the year where people are starting to set their portfolios up for recession and a lower rate environment, expect more flows that might be outside of the S&P 500 and those mega cap stocks.
Okay, that makes some sense to me. Christian, you run an enhanced dividend income ETF, DIVO, your top asset gathering ETF this year. Walk us through what's in it. What kind of market environment and strategy does this work best for?
Yeah, so this is a blue chip focused stock ETF that's actively managed. It's essentially owning companies that are growing their earnings, but also growing their dividends. So it's fairly concentrated in these top quality names. In addition, the manager has the ability to not only harvest dividend income, but write covered calls. That manager is Capital Wealth Planning. Kevin Simpson and Josh Smith manage it, and they've done a great job. It's a 5-star rated fund. And unlike many covered call ETFs that just give you high current income, this is actually delivered in terms of total return with a 3-year annualized total return of 13%, which is right around where the S&P's been over the last 3 years. So you get that high floor of income, but you don't miss out on market participation. We think that high quality approach, especially coming into September and with some of the uncertainty, also adding some of those value names to your portfolio, makes a lot of sense right here.
Tom, what other standout themes do you see this summer? It seemed like AI was all the rage for a while. Is it still? Is that fizzling out? I mean, obviously part of that tech trade.
Yeah, no, AI got a lot of attention for all the right reasons. And there are a lot of different AI opportunities.
Right.
We just ran an AI symposium, and there are 3 different ways that you can invest in AI type ETFs. First, companies that use AI to help get profitability to the bottom line. And it may be with some of those mega cap stocks, the Googles, the Apples, the Amazons of the world. There are also a slew of ETFs that invest specifically in companies that their business is AI. It's all about the profitability and the bottom line and the growth of AI. And then finally, there's some companies that have adopted some AI systematic investment strategies within ETFs. What stocks to buy, when to buy them, when to sell them, how much money to put in them, all within a strategy in an ETF. So there are a lot of choices. But with that being said, it's still in the early stages. There's not a ton of money that's gone into the space, but Court, it's not going away. It's going to be here for a while.
Yeah, it doesn't mean investors aren't interested just because it's in the early stages. That's when you want to get in, right?